It is a Tuesday morning in the suburbs of Atlanta. A man named Derek is sitting in his car in the driveway of his four-bedroom house. He has not gone inside yet. He has been sitting here for 11 minutes. The engine is off. He is staring at his phone. On his screen is his bank account. The balance reads $412. Derek is 41 years old. He has a master's degree. He works in project management at a logistics company. He earns $107,000 a year. He is, on paper, one of the most financially successful people in American history, and he has $412. Derek is not a fictional character invented to make a point. He is, statistically, one of tens of millions of Americans living inside a paradox so normalized that most people inside it do not even realize they are trapped. They feel vaguely stressed. They feel like they are doing everything right. They feel like the math should be working, and every month the math does not work. This video is about why. Not why in the motivational sense, not a pep talk about lattes and avocado toast. We are going to look at the actual structural forces, the pricing pressures, the invisible tax systems, the psychological machinery, and the economic architecture that was quite deliberately built to absorb income as fast as it can be earned. And we are going to do it with real numbers. Because here is what nobody wants to say out loud. The problem is not that people earning six figures are bad at math. The problem is that the math was designed to be bad for them. Let us start at the beginning, and the beginning is a number that feels like success: $100,000. For most of human history, that number was incomprehensible wealth. In 1970, the median American household income was just under $10,000. Adjusted for what money actually bought at the time, $100,000 in 1970 would have felt like being a minor aristocrat. You could buy a house, 2 cars, fund your children's educations, save a meaningful chunk, retire comfortably, and still have money left over for actual leisure. So what happened? The short answer is everything got more expensive at different rates. But that short answer hides a mechanism that is genuinely worth understanding, because it's not random. The things that got most expensive, fastest, are the exact things people earning six figures are most exposed to. Let us talk about what economists call the cost disease, and what most people just call life. In 1980, the average cost of a 4-year public university in the United States was roughly $3,000 per year. Today, the same degree costs on average just over $10,000 per year in tuition alone. Add room and board, and you're looking at $25,000 to $30,000 annually at a public school. Private universities average closer to $60,000. That's a real increase, adjusted for general inflation, of roughly 400%. Not $400, 400%. Healthcare. In 1980, the average American spent about $1,300 per year in today's dollars. Today, the average is close to $13,000 per person annually. That's not the bill from a dramatic surgery. That's just the baseline cost of existing in a body in America in the 21st century. Housing. The median home price in 1970 was around $23,000. Adjusted for general inflation, that's about $170,000 in today's money. The actual median home price today is approximately $420,000. The house did not improve for $250,000 worth. The market simply decided it was worth that much. And the market was backed by 30 years of federal housing and lending policy that inflated values while wages remained relatively flat. 3 costs, 3 categories: education, healthcare, housing. All of them have outpaced general wage growth by margins that range from significant to catastrophic. And these are not optional purchases.
Now you are beginning to see the architecture. Here is where we introduce Derek's actual budget. Not a hypothetical, a real reconstruction based on median figures for a dual-income household earning a combined $107,000 in a mid-cost American city. Atlanta, Denver, Minneapolis, take your pick. The numbers are close enough everywhere that the geography almost does not matter. Gross income, $107,000 per year. $8,917 per month before taxes. Now comes the first invisible haircut. Federal income tax at this bracket, roughly 18% effective rate. That is approximately $1,600 per month gone before Derek sees a dime. Then FICA, Social Security, and Medicare, another 7.65%, another $680. State income tax in Georgia, 5.75%, about $513. We have not bought anything yet. We have not paid rent. We have not filled a gas tank. Derek has lost $2,793 this month to taxes, which is reasonable and necessary, and also means his actual usable income is not $8,917. It is $6,124. That is his real starting point. That is the actual number. Health insurance premium, $420 per month. This is the employer-subsidized rate. The actual cost of the plan is closer to $1,200. Derek's employer covers the rest, which sounds generous until you realize that compensation researchers have demonstrated repeatedly that employer health contributions come directly from what would otherwise be wage increases. The $420 is only part of what Derek actually pays. The rest was just never put in his check. Remaining $5,704. Mortgage. Derek bought his house in 2021, which means he bought it at the exact worst moment in modern American real estate history. Not because he was foolish, but because he was 36, ready, and his family needed the space. He bought a house for $340,000. With a 20-year fixed at 3.1%, his monthly payment would have been around $1,800. But Derek waited 6 months too long. By the time he closed, rates had started climbing. He got 3.8%. His payment is $1,922 per month. Remaining $3,782. 2 car payments. This is actually below average for his bracket. One $340 payment on a used Honda CR-V, one $280 payment on a 3-year-old Camry. That's $620. Car insurance for both, $214. Gas for both, driving to work, school pickups, the occasional weekend trip, approximately $240. Remaining $2,708. Groceries for a family of 4, $920 per month. This is not Whole Foods. This is standard grocery shopping at a mid-tier supermarket, which is itself 22% more expensive than it was in 2020 due to a combination of supply chain disruptions, corporate margin expansion, and commodity price volatility that economists are still debating, but consumers are not because consumers are simply paying it. Utilities, $310. Water, electricity, internet, gas. Cell phones, $160 for 2 lines. Remaining, $318. $318. Before, child care, which for 2 children under 8 averages between $1,500 and $3,500 per month, depending on location. Before the school lunch accounts, before the pediatrician co-pays, before the clothing, the school supplies, the birthday parties, the Amazon packages that show up because something broke or ran out, before the quarterly car maintenance, before Derek's aging parent who needs occasional help, before the credit card minimum payments on the balance that accumulated during the 6 months when everything broke at once 2 years ago. $318. This is not a story about Derek being bad with money. This is a story about a system where a genuinely high income has been precisely carved into nothing by the compounding cost of participation in normal American life. And here's the part that nobody talks about at dinner parties. Derek knows something is wrong. He just can't quite name it. He makes more money than his father ever did. He feels like he should be comfortable. And the distance between what he expected his life to feel like and what it actually feels like generates a low-grade, constant anxiety that he's learned to normalize because everyone around him feels the same way. That normalization is load-bearing. It's part of how the system sustains itself.
Let us pull back for a moment and look at this from a higher altitude. Because what is happening to Derek is not an accident, and it is not a personal failure. It is the predictable output of several interlocking economic trends that accelerated over roughly 40 years. The first trend is wage stagnation relative to productivity. Between 1948 and 1979, worker productivity in America grew by 108%. Hourly compensation grew by 93%. Those numbers are not identical, but they rhyme. Workers got most of what they produced. Between 1979 and 2020, productivity grew by 61%. Hourly compensation for non-supervisory workers grew by about 17%. The connection between what workers produced and what they were paid was severed. The surplus went somewhere. It went to capital, to shareholders, to the top of the income distribution. This is not a conspiracy theory. It is documented in the Economic Policy Institute's annual wage analysis, in Federal Reserve research papers, in data that economists across the political spectrum agree on, even when they disagree about the cause. The second trend is the financialization of housing. There was a period in American history when a house was primarily a place to live, with a secondary function as a savings vehicle. Slowly, through a combination of Federal Reserve policy, tax incentives, mortgage securitization, and eventually the direct participation of institutional investors in the single-family home market, housing became primarily a financial asset that people also happened to inhabit. When something becomes a financial asset, the rules of financial asset markets apply to it. Returns are maximized, supply is often deliberately constrained, and the people who most need the asset, the people trying to get in for the first time, always pay the highest price. In 2022, institutional investors owned approximately 3% of single-family rental homes in the United States. That sounds small until you learn that in some Atlanta zip codes, they owned over 20% of available properties. The effect on prices is not theoretical, it is measurable. The third trend is healthcare cost shifting. In 1980, most employer-sponsored health plans covered roughly 90% of costs after the premium. Today, the average deductible for a family plan is $4,500. The average out-of-pocket maximum is over $8,000. What this means in practice is that a family with insurance can still face a financially devastating medical event, and the risk of that event has been systematically transferred from insurers and employers to individual workers over 4 decades of benefit restructuring. Earning $100,000 in America today means carrying health risk that simply did not exist at equivalent income levels 40 years ago. The fourth trend, and this one is uncomfortable, is consumption normalization at the professional class level.
The lifestyle that signals success in America has been precisely engineered by consumer culture to absorb whatever income rises above survival. This is not about individual weakness. This is about the trillion-dollar machinery of marketing, social signaling, and peer comparison that has spent 70 years perfecting the art of converting income into expenditure before it can become savings. The iPhone is not optional when your colleagues have iPhones and your clients expect you to be reachable. The private school is not optional when the public school in your neighborhood is underfunded and every other family in your social circle has made the same calculation. The gym membership, The streaming subscriptions, the Amazon Prime, the Target runs, the Starbucks, the work wardrobe, the conference trips, the continuing education credits required to keep your professional license, each of these is individually justifiable and collectively ruinous. Nobody made Derek buy any of these things. The system simply made not buying them feel like professional or social failure, and in some cases, it literally was. Now, let us talk about the thing that compounds all of this, the thing that turns a difficult financial situation into a structurally inescapable one: debt. American consumer debt hit $17.5 trillion in 2023. That number is so large it has lost meaning, so let us bring it down to the level of one person. The average American household carries approximately $107,000 in debt, not including mortgages. Credit cards, approximately $6,200. Auto loans, approximately $21,000. Student loans, for households that carry them, the average is over $37,000. Medical debt, approximately $2,700. These are averages. For households in the $80,000 to $120,000 income range, the numbers skew higher, not lower. This is the income band that is creditworthy enough to be extended significant debt and financially stressed enough to actually carry it. Student loans deserve a particular moment here because they represent one of the more consequential policy decisions in American financial history, dressed up as an educational opportunity. In 1980, you could graduate from a public four-year university with minimal debt and an income premium that would make repayment straightforward. The model worked. Then, over 30 years, tuition was allowed to inflate unchecked. Federal loan programs expanded to cover the inflation. Private lending entered the market with predatory structures, and income-based repayment programs were offered as relief while the underlying principal continued to compound. The result is that Americans now collectively carry $1.8 trillion in student loan debt, a figure that has no reasonable historical parallel. A 28-year-old today who attended a moderately priced public university and took on the average loan burden is entering the workforce owing approximately $30,000 at an interest rate that, if they use the standard 10-year repayment plan, will cost them $330 per month, every month, before they buy a single thing. If they deferred payments during graduate school or periods of unemployment, that number is often significantly higher. That $30,000 represents something profound. It represents a claim on future earnings that was extracted from a person before they had any meaningful ability to understand the terms of what they were agreeing to. At 17 or 18 years old, signing loan documents felt like an administrative step in the process of becoming successful. A decade later, it feels like what it actually was, a mortgage on their professional life with no underlying asset. The credit card debt is its own architecture. The average credit card interest rate in America is now 24.7%, not during a penalty period. That is the standard rate. A $6,200 balance at 24.7% with minimum payments will take approximately 18 years to pay off and will cost the holder over $10,000 in interest. These are not predatory fringe products. These are the Visa and MasterCard products issued by the largest banks in the country, advertised during NFL games, offered with airline miles and cash-back rewards, and the warm implication that you are a sophisticated adult who understands the terms. The minimum payment trap is one of the most effective wealth extraction mechanisms ever designed. It is not illegal. It is not even particularly hidden. It is simply presented in a way that makes the monthly cost feel manageable, while the total cost remains invisible. Let us zoom out further now, because what we've been describing, the budget, the structural trends, the debt architecture, all of this exists inside a larger story about who the American economy was rebuilt to serve after 1980. The details are contested politically, but the broad facts are not.
The 1980s brought significant deregulation of financial markets, a reduction in the top marginal income tax rate, and the beginning of a sustained anti-labor policy environment that reduced union membership from approximately 35% of workers in 1960 to roughly 10% today. Each of these changes, taken individually, had reasonable theoretical justifications. Collectively, over decades, they produced a transfer of economic power from labor to capital that has reshaped the meaning of the middle class. The promise of the knowledge economy, the idea that education and professional achievement would deliver the comfortable, stable, prosperous life that previous generations associated with skilled industrial work, was not entirely false. College graduates do earn more than non-college graduates. Professional credentials do provide income premiums. The promise was real. But the infrastructure around that promise, the cost of the education, the healthcare system that professional employment was supposed to provide access to, the housing market in the metropolitan areas where professional work is concentrated, the financial products designed to smooth consumption across an increasingly volatile income landscape, all of that infrastructure has been repriced in ways that consume the premium before it can be banked. The return on investment for a college degree in America, in pure financial terms, has been declining for a decade. This doesn't mean college is worthless. It means the equation changed. The cost went up, the premium held steady or declined, and the debt used to finance the gap went through the ceiling.
We come back to Derek one last time. It is 3 months later. He has made some changes. He refinanced the car he was paying more for and got the payment down by $40. He stopped the streaming service he barely used, saving $16 a month. He meal plans now, which sounds small until you understand that it actually does save about $150 a month in groceries and takeout combined. He opened a high-yield savings account and set up an automatic $40 transfer every payday. It does not feel like much. It is not much. His balance on a Tuesday morning in the driveway is $1,208. It is better. It is not good. Derek has not solved his problem. He has slightly adjusted his position within a structural constraint that has not changed. The mortgage is still what it is. The health insurance is still what it is. Child care is still $940 per month. The student loans are still there. The gap between what he earns and what a stable financial life requires is smaller than it was by maybe $300 or $400 per month. That is not nothing. That is also not the life he was told $107,000 would buy. He will probably be fine. He's employed, educated, healthy, married, and living in a country where fine is a reasonably accessible outcome for people with his profile. Fine is better than the alternative, but fine is not the promise, and the gap between the promise and fine is where a particular kind of American exhaustion lives. It is not dramatic enough to be a crisis. It is not comfortable enough to be contentment. It is the permanent, mild cognitive load of running the numbers again and not quite making them work. So here's the question that this story refuses to resolve neatly because neat resolution would be dishonest. If $100,000, a number that represents genuine achievement, genuine sacrifice, genuine professional success, cannot provide the stable, comfortable, savings-building life that it was supposed to represent, then what number does? Is it 150,000? 200? Does the number just keep moving? And if the number keeps moving, what does that mean about the relationship between work, reward, and the social contract that motivated the work in the first place? What happens to a society where financial security is always just one income bracket above wherever you currently are, where the finish line recedes at approximately the same pace as the runner advances? Economists have different answers. Policy people have different answers. The answers often depend on which part of the mechanism you think is most broken and which intervention you believe is most feasible given the current political landscape. What is harder to dispute is the experience of earning more than your parents ever did in absolute terms and feeling less financially secure than they seem to. the experience of having done the things you were told to do, getting the education, entering the professional class, reaching the income that used to mean arrival, and finding that arrival has been postponed again, indefinitely, for reasons that nobody in a position of authority seems particularly motivated to name clearly. Derek does not have a good answer. The personal finance industry does not have a good answer, though it has a very profitable one. The politicians mostly have talking points. What we have are the numbers, and the numbers say that for a very large number of Americans, in a very large number of cities, doing a very large number of jobs correctly, the math does not work. Not because they cannot do math, because the math was built that way.